Hello everybody, it's Tortoise Investing coming at you today with 5 more dividend stocks that you can buy and hold forever. This is a very popular thing that I do on my channel, and these usually do pretty well, so if that interests you, you want some more dividend videos, make sure to hit that subscribe button, hit the like button, drop a comment down below. Doing all these things makes the YouTube algorithm happy, makes me happy, and let's grow the channel and our portfolios together. I greatly appreciate everyone's support. Now, without further ado, the 5 dividend stocks we're going to be taking a look at today. We got the Hershey Company, Texas Roadhouse, Canadian Pacific Railroad, Target, and Next Era Energy. Starting things off with Hershey. I love Hershey. I especially love it at this price point, and I will buy more if it is around here come Friday. Nothing that I say in today's video is financial advice. Showing you some things I think that you may want to do more research on. See if you like it. Not telling you to buy it or you're going to get guaranteed returns. Either or. Hershey, adjusted free cash flow yield of 3.54%, a dividend yield of 2.18%, a payout ratio of 50%. Not too bad. Revenue's been increasing quicker over the last 5 years, a rate of 6.72%. Over the last 2 years, at a rate of 13.07%. Free cash flow is growing over the last 10 years, 8.27%. Over the last 2 years, look at that, almost 20% up and to the right. That's what you'll love to see. EPS, earnings per share, growing at a rate 10.61% in the last 10 years. Over the last 5 years, 16.69%. Again, up and to the right. Dividend, you're going to see the same thing going on. Almost 11% over the last 10 years. And picking up speed. They are increasing how quickly they raise this dividend, which is great. Hershey is a moat and a half, and I absolutely love this company. The debt, they did have $3.7 billion in debt, and it's paid down to $3.02, so this is something that they are fixing as well. It never really was an issue. They have $3 billion in debt. Their EBITDA is a little over $2 billion. My personal rule of thumb is I don't like companies to have 3 times more debt than what their EBITDA is. So if this was $7 billion in debt, that would be over 3 times. I'd have an issue with it, but I don't have an issue with it. Hershey is great. They're paying down their debt. One thing I wish they would do a little bit more of is share buybacks, but I understand the company is not something that's cheap or really goes on sale all that often, so it's kind of hard to buy your shares back, and you do want your companies to be buying back cheap shares. Put that money to a good use. And what Hershey's been doing is they've been acquiring things. They've been going out and doing some acquisitions and buying companies. So if we take a look here at the return on capital employed, 2020 it was 19%, and then went up to 20.3, 21.8. It is growing. ROC is growing. I like this around 15% plus for my companies I invest in, and this definitely checks pretty much every checkbox. Like, I love Hershey. I can't talk enough about it. But I'll go on to the next one, Texas Roadhouse. I sold my Domino's for this. The reason being is in my eyes, this was at a good price. I had a good gain on my Domino's. I got in around the 340 area, and I sold it around 390. So I got a good little profit on my holding. And debt, when it comes to this company compared to Domino's, it's night and day, and I'll show you in just a second. Just free cash flow yield 2.49%, dividend yield 2.02%, payout ratio 48.4%. Everything's looking good so far. Revenue's grown at a rate of 12.26% over the last 10 years, and it is slowly picking up speed, as you see here, which is very nice. Free cash flow has been increasing at a rate of 15.84% over the last 10 years. Very nice. Again, EPS, besides the 2020 boop, because everything pretty much just collapsed in 2020, over the last 10 years, increasing at a rate of 14.78%. I like it. The dividend is increasing at a rate of 16.44% over the last 10 years. This is a compounding machine. I love to see that. The debt, they have more cash than debt on hand. Of course, capital leases, that's like the rent and stuff. I don't really count that when I'm looking at this. They have $50 million in debt, $173 million in cash as of 2022. phenomenal. Domino's, it's like, it's a lot, but Domino's does use their use debt to do buybacks. But I wanted something with less debt, so I made the switch from Domino's over to Texas Roadhouse. Now, they don't do share buybacks as often. Over the last 5 years, a rate of 1.03%, but here in the last 1 year, 3.11%. I think the company did take advantage of when this was below 100 and gobbled up some shares. I think at one point this was in the 70s. And I'm hoping that's when they were buying back. And they're just like, let's do some buybacks right now. Return on capital employed, 15.56%, 17.09%. So slowly growing. Again, it's over that 15% that I like my companies to be. So, again, a very strong restaurant company in my eyes. I like Texas Roadhouse. I like how the future looks for them. And I like them at this price. Next up, Canadian Pacific Railroad. This says a negative free adjusted cash flow yield. Don't know what that's about. Let's see here. No, that does not make any sense. So, free adjusted cash flow. 3.52%, 54%. We got a dividend yield of 0.73%, payout ratio of 25%. Revenue's been increasing at a rate of 6% over the last 5 years. Take a look at that free cash flow. Free cash flow is increasing at a rate of 30.53% over the last 10 years. That is very rapid and very quick. EPS increased at a rate of 21% as well over the last 10 years. Just up and to the right. It looks like it has slowed down as of late, but this company's doing a lot of good things. A lot of things are ticking in the right direction for them. They got $17.87 billion in debt. They have $5.65 billion in their EBITDA. This doesn't hit the 3-time rule, but when it comes to railroads, they carry a lot more debt usually, and they use that toward buybacks. So if you take a look here, they were buying back shares, but they had the big jump there. Reason being, they've been doing acquisitions. And you know what? You want to increase the share count to do some acquisitions and not take on even more debt. Fine by me. I don't mind that whatsoever. They bought back, let's see here, Kansas City. And we take a look here. It was a $21 billion deal. It becomes the first transcontinental railroad to operate across the United States. Awesome. And this is going to be growth prospects plus below average, below industry debt load and strong fundamentals. Keep the stock chugging along to possible on new highs. Again, none of this is guaranteed. Just wanting to show you the little key points here. I like the future of this company, especially after the acquisition. It's going to be more revenue, more free cash flow coming in. And maybe work on getting that share count back down a bit. But yeah, Canadian Pacific Railroad, I like them. Next up, Target. Target. They have had a year and a half. Just a free cash flow yield of 2.36%, dividend yield 3.31%, free cash flow payout ratio of 73%. A little bit on the high side. It's because they're having a rough year. Their revenue, take a look at the revenue here, been increasing at a rate of 8.46% over the last 5 years. The free cash flow is negative. They had a negative free cash flow for 2023 so far. But the last report that came in, they had an earnings and it was positive again. So hopefully that is a sign of things to come and they can get this back into positive before the year is over with. I know the holiday season's coming up and Target's very popular. Going to probably do quite a bit of business around that time. Now let's take a look here. The EPS kind of all over the place. They had the spike in 2022 and then they had the rough year this year, so it's kind of thrown things off. But if you look here, it's just kind of a nice little trend line up and to the right. The dividend's been increased at a rate of 9.85% over the last 10 years. They did a very small, like right at 2% hike this year. Reason being, they're having free cash flow issues. But again, I think they're going to get everything back on track. I like this company. Their return on capital employed is 11.37%. Again, rough year. Things are going to be lower. But besides that, it's got like an average of around 20. Yeah, well, about 15. If you drew a line through here at the 15, usually hovers around 15, 18. But share outstanding. They are buying back shares. I like this a lot. Over the last 10 years, 3.5%. And here, as of late, over the last 2 years, 4.11, and 1 year, 5.68%. So they are buying back, buying back shares aggressively at these lower prices. And I like that a lot. Now we take a look here. For Target 2023, they're opening up 20 new stores. 175 stores are going to be updated by year's end, ranging from full remodels to additional enhancements such as Ultra Beauty at Target, Apple at Target, Shops and Shops, and expanding capacity for same-day fulfillment centers. They're expanding 6 or more sort station centers. They're going to be open by the end of 2026 to increase shipping speeds, efficiency, capacity, a lot of good things to drive efficiency and fuel growth. I like it. There are goals to achieve $2 to $3 billion in cost savings over the next few years. So, I mean, they're going to start saving money, and whenever they're saving money and figuring things out with that free cash flow, it's going to go right back up. And I like Target for the long term. Lastly, we got Next Era Energy, one of the very few utilities that I personally like. This one and Xcel Energy is the two that I really like. This one has a moat and a half, I feel. It is like the leader in renewable energy in the United States. Let's take a look here. Dividend yield 2.76%, payout ratio 44%. Not too bad. Revenue's been increasing at a rate of 4% over the last 5 years, right at 4% over the last 10 years. With a lot of utility companies, you're going to have a lot of debt. You're going to have negative free cash flow. It's just kind of how these things work with these companies. They're zombies. They take out debt to survive. They take out debt to buy new equipment. And I believe in Next Era Energy over the long haul. Now let's take a look here. EPS been growing right at 5% over the last 2 years. They had the spike and then kind of dropped back down to earth. But again, draw a little regression line here, up and to the right. Dividend's been increased at a rate of 10.98% over the last 10 years. Double-digit growth. They said this is something that they intend to continue doing up to around 2026. And then you're probably going to be looking at, high single digits, mids to high single digits, which is still pretty good. It's going to be beating inflation. Sorry for that. So Next Era Energy, I've got a little news article here pulled up. Next Era Energy is the leading company in the production of electrical power and energy infrastructure in the United States and Canada. The company's business outlook is positive with an increase in demand for renewables. Next Era's investment in renewables and battery storage will cater to the benefits of investors, and their financial outlook is strong with improved profitability, high dividend yield, and a favorable payout ratio. So if you are looking for a utility play, I know that a lot of people go to these as a safe haven in times of, big red days and just down markets. A lot of people turn to utilities. But yeah, 5 dividend stocks you can buy and hold forever. Hope you enjoyed that. As always, do your own research before just investing in anything. And until next time, I hope everyone takes care. See yous.